CBS Brokerage. Today's video is on split dollar arrangements funded with life insurance for closely held businesses. So this is the final of a 5-part video series. The first was on how to have this conversation. The second was on compensation. The third was on retirement planning for highly compensated employees. The fourth was on nonprofit executives and how to plan for retirement for those individuals. And this is the final one on split dollar life insurance plans that can fund any one of these, potentially in combination with other things. Split dollars, a splitting of dollars. By dollars, we're talking about the dollars in this example is used, they're the cash value of a life insurance policy or death benefit. The reason why we're using life insurance to fund the split dollar arrangement, and the split dollars are an arrangement between the employer and the employee agreeing to the split. The life insurance is a funding mechanism, and the life insurance is used versus other alternatives for the following reasons. There's a built-in mechanism for a collateral assignment where the insurer basically ensures the enforcement of the agreement. If you had held in a brokerage account these same funds, for example, the brokerage account is not going to enforce the collateral assignment. You'd have to go legally, possibly sue somebody to get the money that they weren't getting it back, for example. And what I mean by giving it back, recouping the costs that the employer contributed to the plan. Insurance is exempt from certain reporting requirements in ERISA arrangements that other alternatives to insurance don't have. You have to have less than 100 employees to be exempt using insurance, but that's the case. And finally, the tax-deferred nature of the insurance means that the employer won't have to be paying taxes on trading and so forth in between and for this plan, for the benefit of this plan. Meanwhile, the executive gets tax-free income assuming the policy performs as anywhere close to what's been illustrated. So the benefits of this type of plan for an employee is that it's something that's not available to other employees typically. It's an alternative to minority interest in the equity of a business if they ultimately determine that's not what they want because it's illiquid. Basically, they have to sell to the majority partner for some agreed upon amount, whether they agree with it or not, most likely. And they'll have potential input in the actual design of the plan, tons of flexibility. So it's not like a non-qualified plan where they have to follow certain rules and so forth. They can do almost anything they want in the design of this. The employer finds this attractive because they can exclude employees that don't need to be part of it and make it more targeted. They can recoup the costs of this benefit. That's a big feature of this plan. There's low administrative costs. There's a flexibility in the design of the plan. And finally, it's an alternative to giving away equity, which is also attractive to an employer at times. So I'm going to give you an example. I'm going to illustrate graphically an example of an employee-owned policy during employment. So the employer enters into an agreement with the employee and loans the premiums to the employee to fund the insurance policy. The employee makes the contribution to the insurance policy that they will own. They'll have to pay tax on the imputed interest. The imputed interest is generally it's the applicable funds rate or AFR rate that's issued by the U.S. federal government and on a long-term basis. So it's about 1% now. So 1% of whatever the amounts of the premiums were. And if they were to die, the employee, the beneficiaries named would get the death benefits less the amount of the outstanding loan. Another time they might have a tax is when they vest in the benefits. So once the employee actually vests, and you can actually put a vesting schedule on these benefits too, once they vest, the employee owes the tax on it. It's as if they got receipt. Now they might have the money tied up in the insurance policy, so there may be an arrangement with the employer to go ahead and bonus up for the taxes due as well, or pay the taxes out of pocket besides something other than the insurance. Now, at separation of the employee-owned policy, they have to repay the loans. Usually it's going to come from the insurance policy, or the employer could forgive the debt. If they do forgive the debt, the employee owes taxes on the amount forgiven to the IRS. If they have to repay the loan, it's going to come from the insurance policy, as I said. If they don't, they'll be able to surrender for cash, take tax-free retirement income, or just keep the policy for its death benefit. But either way, the beneficiaries get the death benefit. Now, I want to show you an illustration of what this looks like in a real-life example. So, employer cost recovery coming from the employee-owned policy. They pay $50,000 in for 5 years, $250,000 over 5 years total. They get a cost recovery back in year 15. They're pulling their $250,000 back out of the policy. What we see that does is it reduces the cash value from $399 to $158 in this example. And there's still about $840,000 of death benefit. Now, at retirement, age 65, and this is a 40-year-old female we're looking at, using a 5.5 rate of assumption return IUL, they're getting $18,000 a year, $18,444 for 20 years in retirement, tax-free. And there is a minor death benefit left over. It has to be a death benefit to keep those benefits tax-free. So you see that's a minor death benefit just meant to keep costs low. Finally, let's look at an employer-owned policy. So the split dollar arrangement could be made so that the employer owns the policy. The employee and the employer apply for a policy. The employer's going to own it. They're going to go ahead and pay the premiums on the policy and own it. The beneficiary is named by the executive. The executive does have to pay tax on the economic benefit of the insurance, basically the term rates for that death benefit. The death benefit less the premiums paid will be paid out to the beneficiaries in the event of death during the working years. Now at separation, the employer-owned policy, the employer recoups the premiums that they paid from the existing policy that they own. They may also bonus this whole policy to the employee, all of it or some of it. The employee will have to pay tax on the value of the policy at that time. So that's basically the economic value of it. And in that example, with a 40-year-old female where we put $50,000 a year for 5 years, and they forgive the debt, so it's never pulled out of the policy using the same numbers as before. Now you got income of $60,966 for 20 years tax-free. What we want to cover now is that there are things you need to do to get this in place. So it's not a matter of just applying for an insurance policy. You have to get an agreement signed, so forth. So you do need a corporate resolution, a signed split dollar agreement between the executive and the company. An ERISA cover letter has to go to ERISA. That's the one requirement. Policy application, of course, collateral note that between the employer and the employee, which a collateral assignment can be placed to the insurance company, and a notice of consent form, which is sent to which is kept, and then an IRS reporting form 8925 for tax reasons every year, just reporting to the IRS this exists. All these things we can help you with and obtain these, and so these are not difficult things. You might not have them yourself, but we do as for templates. Thank you so much for listening. Hope this has been helpful to you. If you have any questions or have a case you want to discuss, please look us up on the web, cbsbrokerage.net, or contact me using the email address here provided or the telephone number. Thank you so much.